The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Stocks rally, bonds sell off as investors have two decidedly different takeaways from the latest economic data. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Steele. The everything rally except bonds.
Yeah, it's a something rally.
So it's the mostly everything rally. So here's a check on the markets. What I'm trying to understand is what the retail sales data showed us in terms of the market, right? You look at equities telling us that good news is good news, right? But then you look at bonds on the dollar, and that's telling me actually maybe good news is bad news. Maybe the Fed doesn't have to do as much as we thought, with bonds surging on the 2-year up by 14 basis points. We haven't seen that kind of move since all the way back in April, and the dollar index, not to be left out, also rallying as well. So I'm trying to understand good news equals question mark, Romaine.
Yeah, it's definitely a big question, Mark, but there's no doubt that retail sales report we got this morning did at least appear to raise confidence about the resiliency of the economy and the stock market. But that is the big question today. Is that confidence misguided? While the government data did show 10 of the report's 13 categories posting increases, most of the overall gains in that report came from a sharp bounce back in car sales. And the next biggest contributor, that came from must-have purchases like food and beverage. Now, that report came an hour and a half after Walmart raised its guidance for the year, saying it isn't seeing any incremental fraying of customers' financial health. But most of Walmart's sales gains came from less discretionary items and more from must-haves like food and beverages, groceries, an indication that value-seeking shoppers are indeed prioritizing essentials. Now, ultimately, though, it's not consumer spending, but the labor market that remains the key factor for when and by how much the Fed cuts rates. Applications for unemployment benefits have trended up, but remain subdued near those 2019 levels. And the latest numbers out this morning showed a second week of declines, a sign that MasterCard chief economist Michelle Meyer says might mean the Fed doesn't need to be too aggressive.
We are still seeing record low jobless claims. We're just seeing a moderation in the rate of hiring. We're still seeing the consumer spend. We're just seeing a consumer that's a lot more choosy and really conscious of the prices that they're accepting. We're still seeing investment, but again, a prioritization of the type of corporate investment. So to me, it's an economy that needs a normalization of monetary policy, not a dramatic easing of monetary policy.
Michelle Meyer appearing on the network a little bit earlier in the day as we kick you off to the close here at 3 p.m. Eastern Time. Seth Carpenter joining us in the studio. He's the chief global economist over at Morgan Stanley. When you looked at this retail sales report, did you have a definitive opinion on the health of the economy one way or the other, or is this that Rorschach test that we've been getting, it seems like, every week or month?
Yeah, no, I don't think this was a Rorschach test. I think anybody who was expecting weakness in the report was disappointed. This was a solid report. It showed that the consumer is still there. The consumer is still spending. I thought some of the details, though, that you were giving before about the nuances with Walmart, about the way things are going, it's really important. We've been calling for a long time that the economy is going to slow but not slump. We're very constructive on the outlook. We have been for a long time. We were sort of in the first vanguard of soft landing people. But the market really likes absolutes. Yeah. Good or bad, up or down.
Yeah.
And we've been saying,
too. Yeah.
Exactly. And we've been trying to say, well, wait a minute, you can get slowing from the really rapid pace we had next year without it being a disaster. And that's what we're looking for, a moderation.
Well, unpack that for me. I mean, we no doubt cherry-picked a couple of things to sort of make a point. But let's say if you back out that bump up in car sales, which a lot of people think was just catch up, and you back out some of the gains that we saw in food and beverage, what else in there was positive to you?
Well, so I think just first off, when you look at, say, the control group that really gives you a lot of information about consumer spending for GDP. It was positive. There was some risk, and we had in our forecast some actually a lower print just on some of the technicals of the seasonals, and all that clearly wasn't a problem. I think the autos, I think you could sort of put that aside. There's been over the past years some lumpiness. Yeah. The shift, as you were saying, towards away from discretionaries towards more staples, I think is there as well, but that's consistent from last year's really unsustainably strong spending growth to this year going back to something much more normal, and that's what we see in these data.
Which then raises the question, what does this mean for the Fed? 25, how fast do they have to go? I was really struck by Raphael Bostic talking to the FT. And in that piece, he said, waiting brings risk. That's why we need to be vigilant on this, because our policies act with a lag in both directions. We can't afford to be late. We have to act as soon as possible. I mean, it's true, right? If there's a monetary lag in the beginning, there has to be one at the end, too. So what does that mean for the Fed for September?
Completely agree, and you can always count on wisdom from someone named Bostic.
But
right?
he seemed to change. He seemed to change fairly quickly, though, after that inflation number came out yesterday.
So I think that's right, and there is a risk, and I think risk management is the name of the game. We have been now for a long time in the 25 basis points in September, but also 25 basis points at every meeting from now through the middle of next year. For a while, people thought we were extreme. Think there was too much. For a while, people thought we were extreme and not expecting enough. It's a risk. I think inflation now, pretty clearly after the last CPI report, that risk has diminished notably. The labor market has slowed. I think last month's labor market report probably overstated the softness, and so it's balancing risk. I think they can go for rate cuts. I think they can go for a chain of rate cuts because now is the time to try to support the continued expansion.
It is really funny because just last Jobs Friday, it felt like you guys were the really conservative ones in terms of rate cuts. So you don't think 100 basis points, the market's still off on that for this year?
I think that's probably overstating things. Now remember, the market has to price not just the single most likely outcome, which is what our forecast is, but also the whole set of probabilities around that. And so we could be wrong. At some point, we're going to be wrong. And it probably is skewed a little bit more towards more slowing than less. And so I don't think the market's sort of completely out of whack, but I do think I'm still comfortable with our forecast.
When you look at the market reaction to this, and we're going to talk about that a little bit deeper with our next guest, but I am curious as to whether they're saying the same thing. There's a lot of people looking at the rally in stocks, the sell-off in bonds, and then they looking at credit spreads and saying, well, they're not blowing out. I mean, put that all together. What is that telling us about sentiment out there right now?
Absolutely. I think people are searching just a little bit for what exactly it does mean. We've been looking for this soft landing where you could get reasonably tight credit spreads, where you can get interest rates coming down a bit, but not crashing. And I think the rally that we saw in rates, when rates came down a lot on the payrolls print, I think it was because a lot of people got spooked. Maybe things have to get a lot worse. And so the rise in rates now, I think, is people getting much more comfortable that the Fed doesn't have to be quite as aggressive to save the economy. And the equity market is in fact saying the same thing as well. Probably less risk of a recession than people thought before. We can go back to being a little bit more constructive on the outlook. That's been our view. Credit spreads are off their tights. They're nowhere near as enthusiastic as they were maybe a little while ago, but in the grand scheme of things, they still look pretty solid.
So markets are repricing disaster. Is that
moving away from it? I like to think of it as markets are moving away from disaster and coming closer to Morgan Stanley's view.
I'm sure you do. Where could you be wrong? Where's the kink?
So, I mean, we are going to get, at the very beginning of September, right after Labor Day, the labor market report for August. Tomorrow, in fact, we're going to get state-level data for the July report, and so we're going to understand how much of that soft July report was maybe hurricane or not. The print we get at the beginning of September for August is going to tell us, is this, in fact, a trend down? Or was July really just a bit of noise and we're sort of bouncing back? Our best guess, our baseline is the second, that we're going to learn that people overreacted to July, but that's where we could be wrong.
All right, great stuff, Seth. Always wonderful to see you and get your insights. Seth Carpenter, Chief Global Economist at Morgan Stanley, helping to break down the economic data that we got this morning. When we come back here on The Close, a fuller breakdown of the market reaction to that with Nisha Patel over at Parametric. This is Bloomberg.
Season is here.
You're seeing back-to-back billion-dollar-plus quarters.
The forward indicators were so positive.
Bloomberg is first to break the numbers.
Texas Instruments out, folks.
Goldman Sachs taking a look at Mattel.
There is something for everybody.
With the smartest insights.
People are whitewashing AI.
Wallets are under pressure.
We are committed to EVs. They're going to happen.
Earnings season in full swing.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
S&P still up by about 1.6%, surging, and guess what? So our bond yield. So I love this chart. It shows that big move in the 2-year, right? We haven't seen that since April, and yields moving, like I mentioned, and S&P also adding to its 6-day winning streak. I write my own intro and then I mess it up. What does that mean?
I don't know.
So usually these two don't necessarily move in tandem. That move in the bond market and that move in the equity market, and it really was a head scratcher as to why that's actually happening.
What I love about this chart is, Alex, probably in a couple of days, you're going to have to flip this chart upside down and tell the exact opposite story.
I know, but at least we have it made. Nisha Patel is Senior Fixed Income Portfolio Manager over at Parametric. Nisha, what do you make of the reaction function today in the market in relation to the jobless claims data and the retail sales data?
This is a reversal of that flight to quality and that rally that we saw after the jobs number, right? So this is a correction in the market saying, look, things are not as bad as they seem. And so we're viewing this as really, two main takeaways. This is kind of a perfect scenario. It gives the Fed a lot of room to continue to cut, not that 50 basis point cut that might have been even jarring for the market, but get rates, long-term rates more in line. And for investors, this is a welcome gift, right? You have bond yields that are up, clients that have been sitting in cash. So we're viewing this as a very welcome opportunity.
Opportunity to where?
Opportunity to invest in bonds. So if you think about, I know we all talk about all this cash sitting on the sidelines, right? But if you take a look at where you're generating income, where you can put money to work, these are yields that we haven't seen in a long time. So even just looking at the 10-year Treasury, average has been, since the financial crisis, about 2.5%. We're almost back up to a 4%. So this, again, is that gift for clients that have been sitting in cash, focused on income. You can earn a good amount of income in high-quality bonds, and this is something we haven't seen in a while.
But why do I need to take on that duration risk right now? Because, I mean, I don't know if you're using bonds in the broadest sense, because I'm still looking at a 6-month bill where I can get 5%. And and at least before today, you were seeing the rest of the curve kind of dip down here. So I feel like that gap between, say, a 10-year and say a 6-month or even a 1-year is just getting wider.
You teed this up so well for me. So but this is a number one question we've been having with our clients, right? I'm earning 5% or I'm earning 4.5%. That is very temporary and that's short-lived, right? As you know, as soon as the Fed starts cutting, that's going to start readjusting. So your reinvestment risk is very high. Once that starts rolling off and matures in 6 months, then what? Right, so our point is extend out the curve for two things. Lock in yields for an extended period of time, for 5 years, even 10 years. And then the benefit is that you have some duration. So look, we may not be in a rapid easing cycle anymore, but bonds have historically done very well, right, when you see a reshaping of the yield curve. And so as you enter that easing cycle, in a Fed easing cycle, by having duration, right? So because you expect bond yields to fall as the Fed starts to ease.
So the gains are more price?
So the gains are more price and you have price appreciation. So let's just say you have a 5-year duration bond and yields fall 1%, hypothetically, right? That's about a 5% price appreciation to make this very kind of back of the envelope type of math, plus your income that you could generate.
Just though, I am curious though about the potential for seasonal issues, and obviously in seasonal, I'm also putting in sort of the U.S. election and other things that are coming up along the way. A lot of people are going to be either reticent to enter new positions or even close out old positions. There's going to be tax implications, I think, going into 2025 that are unlike what people had to deal with coming into 2024.
Yes. So I think there's a few things happening here. I mean, look, in a lot of markets, my team and I focus in, the corporate bond market, municipal bond market. We've seen a lot of issuance. And it's no different than most election years. Most issuers want to get ahead of any volatility around the election time. But listen, demand's also been very robust, right? You've had $1 trillion of issuance in the IG corporate market. And, not even a blink of the eye. I mean, demand has been there to soak this up. So we're telling our clients that while you have a little bit of volatility, this window's open a little bit longer with some uncertainty, which is a good thing. Get in now before you start seeing massive flows and money moving into motion, in which case that's kind of the lagging money that comes in, right? You want to be kind of the smart mover, the first mover into bonds. So we're really kind of recommending this to our clients.
When we saw that spike in the VIX to like 60, 65, you had corporate credit spreads didn't really do much. I mean, they widened a little bit, but there was no blowout. What does that tell you? Is that a demand story? Is it or was that just, hey, things aren't that bad in the economy story?
Yeah, I really think it's the latter, right? So today's spreads are tight, but you really have it fully baked in and priced in that the economy's not I mean, we're in a great spot. Some of the data is coming in softer, but this is what a tight monetary policy should be doing. So even today with where spreads are, you have a lot of cushion for spreads to widen out a little bit from here, right? And that's in a scenario where, you know, things could be pretty bad from an economy standpoint. If it truly is a soft landing, spreads may not have to adjust a lot, but then you have the duration and you're able to lock in yield. So I think this credit spread story to us has really been telling the story that I think equity market is now saying that, look, things are really not that bad. So we're saying, look, this is a softer landing more scenario. Things are looking great.
Yeah.
Get into the market and lock in these yields.
We only have time, I think, for one more question, but I do want to get your thoughts on volatility. I mean, we had a big spate of it, I guess, just over the last couple of weeks. It's subsided now, but everyone seems to be under the mindset that volatility will pick up over the next couple, 2 or 3 months.
Yes, look, I think let's just take the past week and a half as a snapshot of volatility, right? I mean, everything, and we've been saying this for a while, but it seems even more so, everything is going to be so data dependent. Because now you have two schools of thought possibly of saying, look, are things good? Every time a number comes out, today's number justifies, look, things are not so bad. As soon as you have a weak print, well, bad news will start getting priced into the market. Every piece of data, I think, just gives more room for volatility for both bonds and stocks. Look, bonds, remember, at the end of last year, were pricing in 6 rate cuts. And then in April, we're actually pricing in 1 hike, right? And here we are back to 3 to 4 and actually less than 4 in just a matter of 1 print. So I think volatility is here to stay. And look, for some investors that, you know, may be tough to stomach. What we're just saying is this window of opportunity from an absolute yields perspective is very attractive for bond investors.
All right, great stuff, yes. Nisha. Great to have you. Nisha Patel, Senior Fixed Income Portfolio Manager as stocks hit session highs and bonds right now, Treasuries hitting session lows. A lot more coming up here on the big program. Between that hot retail sales number and Walmart boosting its yearly outlook, consumers are indeed still spending. We're going to break down some of the trends hidden in those numbers with the CEO of Coresight Research.
All right, plus, Buffett is slicing and dicing, adding to Berkshire's portfolio. We're watching some of the new names he loves and the old names he's ditching straight from Berkshire's 13F filing.
And Dutch Brothers Coffee, UBS raising its recommendation on that stock to buy. We're going to talk to the analyst behind that call and why this has suddenly become one of the hottest stocks out there. All that and more coming up in a second, right here on The Close. This is Bloomberg. All right, time now for our top calls. The big movers on the back of analyst recommendations. And we start off today with Robinhood, snagging an upgrade to buy over at Deutsche Bank, with the firm saying that between the recent market sell-off and potentially volatile conditions into the U.S. elections, e-brokers like Robinhood are best positioned in the near term. They see more than 20% upside for Robinhood in the next year. The share is getting a 5% run up here on the day. Next in line, let's take a look at Brinker International, the owner of Chili's. KeyBank asking for seconds with an upgrade to overweight, with the analysts believing that those recent results that we got out of the company that sent the shares down 30%, that they were misunderstood and they deserve credit for improved same-store sales and increased traffic. The analyst says the company is making the right choices and the earnings will soon show it. The share's up 8% on the day, and we're going to talk to the CEO of Brinkers just a few minutes later in the show. And finally, let's take a look at Dutch Brothers. Raised to buy from neutral over at UBS, a new price target of $39. And the firm saying that it sees several factors that could fuel the company's growth, including the rollout of mobile ordering and a wide open path to opening 4,000 stores. Those shares rallying 7% on the day, and those are some of our top calls. But we want to stay on that last one and get to the analyst behind it. Dennis Geiger joining us right now over at UBS. And that's a pretty bold expansion for a company that I think just a few years ago, a lot of people even weren't familiar with. Is the cost structure of that expansion going to be commensurate with the revenue and profits that it could generate?
Yeah, absolutely. If we look back over the last several years, you've seen significant growth, right? We've seen, depending on the year, 20+% store growth. As we look ahead, we think at least mid-teens % store growth going forward. And really that's underpinned by a few things. It's strong unit volumes where they're opening, particularly in newer markets. It's strong return on that investment. Depending on the structure they use, they can have up to 65% cash on cash returns on those stores. So with that level of return, we think very much supportive of continued opportunity for growth, and obviously tremendous white space across the rest of the country for a brand that is very much on trend and again is seeing strong results in new markets that they're going into.
Dennis, talk about that trend part of this, because there are a lot of people that will look at this and they'll say, okay, what's really different about a Dutch Bros versus either a Dunkin' or a Starbucks or any other company out there that specializes in these sort of to-go coffee drinks? What is special about this brand?
Yeah, I think it's a few things. I think you have to look at menu first, right? Where a big portion of the menu, of course, is coffee. Call it, coffee-based, maybe being half of that. You have a quarter of the menu or so that's energy drinks. We sort of know that's an on-trend category. The growth there is strong. Quite frankly, you're seeing other larger brands like Dunkin', like Starbucks, trying to mimic and trying to roll out their own energy beverage. So I think very unique from a menu perspective, and then from a culture perspective. When you go to the restaurant, you get that sense from the employee of the culture within the store. The service levels are strong. So again, it's a differentiated menu. It's a differentiated experience for the customer. Heavy drive-through, sort of in and out, and maybe there's an opportunity we can touch on there as it relates to mobile order on the phone. But really some differentiation, menu and customer experience, which I think has driven a lot of that success over the last many years.
At this point, Dennis, who's a fair competitor to Dutch Brothers? Like, Starbucks is so huge, so that maybe isn't the best comparison. So who can I think of as a good comp?
Yeah, I think you can look at a lot of the other private brands, of which there are some. Seven Brew might be one on the private side, who's doing the combination of coffee as well as energy. Again, I think you're going to see and will continue to see growth from more of these private, smaller, emerging brands looking to try and replicate some of the success that Dutch Bros has seen. And again, I think you're going to see some of the larger players try to do some similar things with energy, with some of the on-trend coffee drinks, protein coffee, et cetera, that has driven some really strong sales and very good margins to boot.
And Dennis, when you talk about the mobile growth rollout, where are they in that? What's the upside there? And also, what's the money they got to put down for that?
Yep. So really significant opportunity, we think. Only in about 200 stores out of the 900 plus or so across the country right now. We expect the majority of that will be done by the end of 2024. So generally be in place for 2025. We think this is going to be again a big unlock for the company. You look at Starbucks back in 2016 or so, maybe right after they had launched it, they got to probably 4% utilization. Now they're at over 30% utilization. I think if Dutch Bros can see that trajectory, we think some really solid same-store sales contribution, at least a couple of points next year. And I should mention, obviously, mobile adoption much further along today, of course, than back then. So we really think some nice benefits potentially for Dutch Bros into 25.
All right, Dennis, appreciate it. Dennis Geiger over at UBS. Thank you so very much. I'm looking at the 911.
Yeah. Okay.
6 shots of espresso.
What?
Half and half Irish cream
syrup.
Legal?
Is that legal?
Calories for a hot one, over 600.
Okay, well, I'm going to see if I'm going to one-up you, because I was taking a look at the Cookie Dough Freeze, which is a blended chocolate chip cookie dough coffee with soft top and cookie dough pieces. It does not actually list the nutrition information on it, but I'm sure it must be high.
Oh, that's a whole other thing that I'm looking at.
Actually, I don't want to know it. I just want to enjoy my cookie in a cup, which apparently is all it is.
Okay, I'm looking at it. All right, coming up, we're going to talk more about retail sales and the resilience of the consumer. This is Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. And just to keeping track here, Walmart stock still up over 6%, obviously, as consumers are still spending.
It was a great quarter.
It was.
I mean, I know a lot of people are going to quibble, saying, it's mostly from groceries and all that. But, I found an interesting stat today. I didn't realize Walmart gets 60% of their revenue now from groceries, from food items.
Right?
Yeah, I mean, I knew they were big in groceries. I didn't know they were that big.
Huge, which is interesting, too. I think the question becomes how people are paying for stuff. And this chart comes from the New York Fed. It was released on Monday, and it basically shows that the the average likelihood that consumers would miss a debt payment in the next 3 months rose to over 13%. Haven't seen that since 2020.
Yeah, and that's a concern. I don't know. Some people dismiss it. They say, oh, well, you got to look at this ratio of something and it's not as bad. But I don't know. It seems bad to me.
I mean, so you're spending, but how are you spending? That must make a difference. Joining us for more is Deborah Weinswig, founder and CEO of Coresight Research, a data-driven research firm that focuses on the intersection of retail and technology. What did you learn from Walmart and retail sales from today?
I think that when we look at the Walmart numbers, the amount of revenue and operating margin being driven by data was unbelievable. What they're saying with regards to retail media. So we're talking alternative revenue sources, which to me is allowing them to go back and reinvest. I think they said, right, we're kind of like people-led, tech-driven. And that really came through for me in the quarter. They also threw in, right, they're doing a lot around generative AI and how you search and how you experience the store. They're focusing on supply chain. Every box I would want to check, they checked for me. And I can't remember that happening on an earnings call in general in quite some time. So like you said, it was really kind of all coming up roses.
I mean, if we basically have higher end consumers trading down now to Walmart, so it's really trying to expand that pool of people to buy stuff. If the economy recovers, though, how can they keep attracting those consumers?
I think that it's more than that, too. And I do agree that there's this, maybe it's a trade down, maybe it's a trade over. But as they're making it easier to shop, like truly omnichannel, right? We've been talking about omnichannel since the beginning of time. But now that, it truly is seamless. And I think with the Walmart Plus membership growing, right, we're seeing Sam's Club membership growing quite nicely. This idea that it's a seamless experience if it's out of stock in your local store, right? So maybe you can't pick it up today or get it delivered today, but you can have it delivered to you all in the same kind of basket. We're really simplifying the sales process for the consumer. And I think one of the things that we haven't talked about yet is what they're doing with third-party marketplaces. You're improving the selection. I mean, you can get Chanel and Gucci and all of that now on Walmart's marketplace, but it's all in one cart. So I think the whole experience is truly changing and evolving at a pace that is certainly faster than what many investors expected.
Why aren't we seeing other major retailers sort of follow this lead? I know you have sort of more pure play online retailers like Amazon, which are trying to do something similar, obviously, with their brick and mortar footprint as well. But you haven't necessarily seen a Target push this deep the way Walmart has, or some of the other competitors.
Now, I think that, I will say I've always thought that Walmart with its size would take, and I think many of us on the investing side would take longer to do things than they do. And whether it's around supply chain transformation, right, their ability to monetize their data and whatnot. And they've just gotten to kind of the end game faster. And right now they have to create a new story. But I think they've probably gotten things done a year earlier than even they would have thought. Mm-hmm. And so I think it's more of the ability to almost do like these surges and from almost a mechanization perspective, get things done in a very kind of systematic way so that they have more wins than losses and they're able to get the consumer there in a different way and a faster way than maybe some of the competitors. And I do think that if you think about the global picture, they're learning so much, whether it's from Flipkart in India, from China, from Walmex, that they're able to bring back to the home market that I think is also allowing them to ignite a lot of what we're seeing and what really came to roost in this quarter.
Yeah, I want to broaden this conversation out a little bit to just the overall health of the consumer, because there's been some speculation that some of what made this a great quarter for Walmart was that they had more customers who maybe weren't traditional Walmart customers gravitating to their stores in search of value. Is that a trend that you're seeing?
I think that we are definitely seeing this, because I actually thought we'd see it a little bit earlier in the year, because in an election year, we almost always see the consumers seek for value because there is a lot of volatility, right? That's just math. And so, right, when there's a lot of headlines and they're usually negative, right, that does change how the consumer perceives their own health, right? And I mean health of their balance sheet, health of their kind of earning potential and whatnot. And so I think that that's number one. Secondly, we've been in a kind of highly inflationary environment, especially it relates to groceries. Right, the average consumer goes to the grocery store 2.1 times per week. So these are prices that they are seeing and that are top of mind for them. And, Walmart, I think, was the first to really start to talk about lowering prices, rollbacks, right? Everyday low prices. And I think that that's gained mind share and market share for them. And then lastly, this idea that the consumer has, certainly those savings from, 2020 and 21 are not necessarily what they were. And I think they're looking at their bank accounts and thinking about how they're spending. I mean, their 401ks are a totally different story. So it's a bit of like you're betwixt and between. I think overall they feel good, but they don't feel great.
Yeah. Good, but not great. That's a great description, actually. Deborah, what are your clients asking you right now? Like, what's the number one question that you're getting?
The number one question is 25 or 50 basis points in September. That is absolutely number one. Number two, why are we not seeing enough focus on supply chain? And number three, what are retailers doing with Gen AI right now that's actually making an impact?
All right, Deborah, great stuff. Great to talk to you. Deborah Weinswig, she's the founder and CEO over at Coresight Research, keeping an eye on some of those trends in the retail space. Alex, we did have some breaking news just a little while ago, and this involving Kroger. Of course, they're almost 2 years into this effort now to merge with the other grocery store chain in this country, Albertsons. Of course, a deal that's been under a lot of regulatory scrutiny for whether it's going to raise prices for consumers. Now, previously, they had said they were willing to offer as much as $500 million in price cuts to consumers, and now doubling that, pledging to cut grocery prices by $1 billion if that merger is actually approved by the government.
And I'm finding the timing of this particular part very interesting. Remember the other day, it was yesterday, Vice President Kamala Harris calling for a federal ban on food and grocery price gouging, also specifically targeting the Kroger-Albertson deal as one that she really wants to take another look at. So it's interesting to see that come down now. Yeah, and this just seems like kind of bad timing. I mean, even when it was first announced, people said it was bad timing, and now with so many people hyper-focused on consumer costs here, they've definitely got to offer something to give people a little bit more confidence. More on board on that. Also, we have more retail coming out next week, right? Target. That's going to be quite interesting.
Target, Macy's.
And my question with Target, though, is Walmart eating some of Target's lunch? Or is Target going to hold up because it is promotional? They're going to be lapping some of the boycotts that they had about a year ago. And is that going to wind up helping them, or is it just still Walmart's story?
I am curious about that, too. I think the only thing that from our BI analysts they talk about is that Target's footprint is a little bit different than Walmart. So there's the Venn diagram isn't quite a full overlap, but I don't know if that helps them longer term or not. But,
yeah, and you know Macy's, right? Sales.
And Macy's.
I'm going to want to know about sales. Will we have sales at Bloomingdale's?
This is for a friend? You're asking
I'm
for a
asking
friend?
for a friend.
Okay.
That's the only thing I care about is inventory of Bloomingdale's for Macy's, so we'll get back to you.
All right. When we come back, though, we are going to take a look at some of those 13F filings and some of the big stocks that are moving on the back of them, particularly some of the ones that Berkshire Hathaway has decided to include in its portfolio. One of them is an investment in your face. Stock of the Hour is coming up next. This is The Close on Bloomberg. All right, it's time now for our stock of the hour, or I should say stocks, plural, of the hour. Berkshire Hathaway boosting its financial stock weighting by more than any other industry in the 13F filings that have been rolling out over the last couple of days. The company also taking a new position in Ulta Beauty, SiriusXM Holdings, and they cut back their massive stake in Apple by about half and shed off Snowflake. Abigail Doolittle joining us right now to wrap this all up for us. Let's start off with Apple here. I mean, this is a stock that's been on a pretty good run, but when you sell off half the stake, is this profit taking or is there something more?
Well, I think it's a little bit of both. So the really interesting thing about Apple is, of course, they started selling this position at the beginning of last December, and in the recent report, and now the 13F confirmed that about half of their position is gone. The interesting thing is it's still their largest holding at about 33% of the total portfolio. Now, his quote-unquote lieutenants, they apparently were the people who back in the day bought Apple, Ted Weschler and Todd Combs. But it is Warren Buffett who is known to have ramped it up significantly and then to have taken the profits. And it makes a lot of sense in terms of the way they did it. When they bought it 11 times forward earnings. And when they sold it recently or over the course of the last, however many months, 33 times. So in some ways, it's a call on, it's a call on the market. It suggests that they are negative in some ways on equities and repurchasing. And you can also see this with their cash position. Their cash position has really been bolstered higher.
And near Kesar, just to that valuation standpoint, we had a great column today about how this might have been a valuation call that, they still like Apple, but as you said, 33 times or whatever you said, times earnings.
Oh, yeah.
Maybe not as valuable as it used to be.
It's usually it's like, hey, I'm gonna get it to cash because I made a nice profit and do something with the cash. That still is not happening. There's still a boatload of cash. What I find interesting, though, is that Warren Buffett's known for investing in things he can see, he can touch, he can see, he can feel, and they started a stake in Ulta.
One of our favorites, actually.
Invest in our base. Well, what I
read once again, I'm out of this.
No, he's into it.
Oh, you're into Ulta.
So what do we know here about that stake?
So it is $266 million. It is a new position for them, and I think that their main thing here is that they got it on sale. Even with today's greater than 10% rally, the stock is down 25% year to date. And if I take a quick look at earnings or valuation, forward 14 times. So it is relatively cheap. And I think that it's aligned with your thesis, Alex, that you want to invest in your face.
Yeah, well, somebody does, certainly so. And obviously Buffett and his lieutenants think so as well. There were a couple other names in there that we threw out as well that I think caught up some people's attentions.
Yes. Well, Snowflake caught my attention because Berkshire Hathaway and Snowflake, the software company, who knew? But supposedly that could have been, it's speculative, that a trading position on the part of Ted or Todd. We don't know that for sure, but that's a possibility. They also bought some Sirius. That may be some sort of an arbitrage deal with Liberty Media.
Yeah, that one really was a head scratcher.
Yes, it's also in terms of the complexity of the arbitrage. It's definitely, frankly, it's a little bit above my head. But it's interesting to see that they are. And then they added to their Chubb position. They paired Capital One and Chevron. And then it's interesting to note, just because this whole portfolio really is a microcosm of the S&P 500 and the economy, energy and railroads are not doing well. So when I think about them taking off positions from Apple at 33 times after buying it at 10 times, that they have this cash pile here, 45% of their investments. It seems like they're not market timers, but it seems as though there's some possibility that they're at least hunkering down for some sort of a possible storm.
Well, except, for Chevron, like if Exxon might have been a different story if he'd owned that stock at the end of the day. All right, Abigail, thanks a lot. Really appreciate that. Bloomberg's Abigail Doolittle joining us on Warren Buffett and those lovely 13F filings. All right, coming up, we are counting it down to the closing bell. 15 minutes to go. Lauren Goodwin, economist and chief market strategist at New York Life Investments, will be joining us next. This is The Close on Bloomberg.
We've been calling for a long time that the economy is going to slow but not slump. We're very constructive on the outlook. We have been for a long time. We were sort of in the first vanguard of soft landing people.
Seth Carpenter there, the chief global economist over at Morgan Stanley. He kicked us off to the close just about 50 minutes ago, Alex, a day where we're seeing a huge rally right now in the equity market and a huge sell-off in the bond market on the back of those relatively encouraging retail sales numbers.
Yeah, and tech really continuing to climb higher here, very much outperforming. The Russell jumping higher as well. You have a consumer discretionary, obviously the best performing sector within the S&P. But my question is, again, volume. Volume is still really, really light. Are we really going to be able to take these gains seriously? However, we were talking about, I was reading an article by Natalia Knežević of the Bloomberg Equities team about systemic funds are now buyers rather than sellers, that the upside could be for them as well.
Is that a contrarian signal, or am I just supposed to buy right into that and say, okay, we're going?
I think we're just going to the races a little bit.
All right, well, everybody's really trying to read the tea leaves here of where the market goes next. And of course, where the market goes next is dependent on where the economy goes next. Lauren Goodwin is joining us right now, who, well, fortunately for us, wears two hats. She's an economist and chief market strategist at New York Life Investments. All right, Lauren, let's get right to it. I mean, the overarching question really is, what kind of economy are we in right now? And did the data that we got today, or really over the last 3 days, provide any real clarity on that?
I think it did provide clarity because this is an economy that is slowing, but for which the normal indicators that I would expect to signal it's time to move risk off, recession is at our doorstep, those signals are not yet here. Even with slowing inflation, a slowing labor market, I would typically look for unemployment claims rising above the 260 level or a deterioration in earnings growth to signal that recession is at our doorstep. Those are not what we're seeing in the marketplace. And so though I do expect that over the next 6-9 months, the economy economy will be touching into a mild recession until we see that further evidence of a more pronounced slowdown. Investors need to be fully invested and more balanced in their approach to portfolio strategy.
Well, what does that look like, though, Lauren, assuming that your economic scenario plays out? What does balance look like?
Well, importantly, the data that we've seen over the past couple of weeks have marked a meaningful transition. In fact, I think it would be difficult to overstate how important the transition we've seen in the data. When the inflation figures have moved into, let's say, better control, the market has become much more focused on the labor market, which is really growth. That means that good news is now good news, bad news is now bad news, and the market's going to be much more susceptible, we believe, to indicators in either direction. So today, constructive news from retail sales, constructive news from unemployment claims. That's a day where we can see the market move in a more risk-on direction. But we're likely to see days in the opposite direction as well. And so volatility in both directions, that means starting to diversify and broaden your bets. And we can elaborate on that. But that more balanced portfolio construction, we think, is the most important takeaway from the market right now.
Lauren, are bonds telling us the same story right now?
They are, to an extent. While we're not seeing spreads widen meaningfully in credit, again, the economic data is holding up relatively well. We are starting to see moves across the Treasury curve that suggest that this economy is likely to be slowing and that changes in the bond market should be expected. One of the things that investors are often sort of grappling with are not only spreads versus rates, but also long versus short duration. One of the key messages I've been hearing in the past couple of weeks from other investors is that as the Fed is beginning to cut rates and the yield curve normalizes, it's time to move longer in duration. One caution that we have about that, one area where we're not as comfortable saying that view just blanket outright, is the fact that we are seeing much more supply and uneven demand in the long end of the Treasury curve. And so while we do expect that for most investors, it's appropriate to move out of cash into bonds, start locking in higher rates, which is naturally going to move a portfolio longer duration in essence. We like to balance, take a more neutral approach to duration as a result of what we expect to be lots of interest rate volatility ahead.
You're really echoing what our previous guests have also said, in that we're seeing sort of a slowing but not a slump in the economy, and then to allocate accordingly. Where does that put small caps?
In order to see small caps really outperform, you need to be in a re-accelerating economy, a clear recovery. We're going to have days where the market feels like that, but it's not likely to be a durable investment strategy until we're on the other side of, again, what I expect to be a mild recession. That's not just to do with small companies, though. It really is the nature of the small cap indices in the US and other countries as well, where profitability and higher interest rates have been a challenge, and where really strong investor confidence is necessary to see a sustained recovery. In other areas of small business, like in private equity, the lower middle market as an example, we do think that there are some opportunities for more value creation, but that's a relatively sort of deeper look into the markets. For small caps specifically, we're not convinced that that's a durable play.
So then where does that sort of leave the Fed, Lauren? I mean, obviously everyone's looking ahead to the September Fed meeting. Pretty much the expectation is we are going to get a cut. But more importantly, what's the communication going forward with regards to maybe continuing that easing cycle, assuming it starts in September? Is the data there, as Jay Powell would say, enough of it there for them to continue with a full-blown easing cycle?
I think that the inflation report we saw yesterday met the bar that the Fed needed in order to signal consecutive interest rate cuts over the next few quarters. This is an economy that is coming much better into balance, slowing but still relatively sustained. The Fed sees its policy as restrictive, and that's not an environment, especially with inflation indicators pointing closer to the Fed's end of year for the next couple of years targets. It's not an environment where a highly restrictive stance is necessary. And so I expect that we will start to see a signal towards not just a cut in September, but the likelihood of sustained cuts back to neutral. Let's call it a 3 to 3.5% policy rate. I think the real challenge for the Fed and the needle that they're likely to thread is that it's tough to signal that interest rate cuts quarter after quarter, meeting after meeting, are necessary without some slowdown in the economy. And because the market is going to be more focused on growth, signaling that move back to neutral as opposed to panic is going to be a communication challenge for them.
All right, Lauren. Going to have to leave it there. Lauren Goodwin, economist and chief market strategist at New York Life Investments, helping us count you down to these closing bells. Alex, just about 2.5 minutes to go. Stocks still holding on to sizable gains.
And money market funds now, new record, $6.22 trillion. Yeah. We're not seeing that moving anywhere else.
You're making 5%. Why would you move it out right now? A lot of people just see the safety of it, right? 5% with effectively no risk.
Nisha Patel saying this is your window, right? You don't take the window, then what happens?
Well, that's the other problem is you're trying to time something and maybe you just don't time it. Maybe you just roll out the duration. Full market coverage coming up right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Alex Steele, taking you through the closing bell, a global simulcast. It starts now with Scarlett Fu in the TV studio, Carol Masser and Tim Stenovic in the radio booth, as we welcome our audiences across our Bloomberg platforms. That includes our partnership with YouTube on yet another day here where we're seeing some really, really strong moves in the equity market.
Yeah, well, we're up 6 days in a row here on the S&P 500. And so we've seen quite a bounce in those days. It feels like that soft landing we're talking about a lot. Is it possible that that is exactly what's happening? We'll see what Jay Powell has to say next week at Jackson Hole.
Yeah, I mean, look, I think it's fair to say that investors really like the retail data the retail sales data that they got earlier today. Walmart and Walmart commentary about the American consumer certainly helping to lift the markets as well.
Yeah, good news is good news once again, because last Monday, bad news was bad news, and then we turned into bad news is good news.
I can't keep track of that.
Exactly. But you know what the real catalyst is going to be, I think, next week when NVIDIA reports earnings. There's still earnings coming up from a big tech company.
Yeah, next week, Jackson Hole. Don't forget that. We got to get through that before we get to NVIDIA. I still think the bond market's quite interesting. I was really flummoxed by that move as well as the equity move. Are they saying the same thing? Or are they saying something different? It seems like Seth Carpenter, Morgan Stanley guys, was talking to us that it's all about slow, not slump, and that from that perspective, we're all kind of on the same page.
Yeah, absolutely. Here, we should point out volatility has been tamped down quite a bit. I was just taking a look since that blowout a couple of weeks ago in the VIX. 7 of the past 8 sessions, we've seen the VIX drop, and now today, right around that 15 level, so actually below where it was before all of this really started to pop off all the way back at the end of July. The numbers here for the day are going to please a lot of equity investors. Green across the screen with the Dow Jones Industrial Average back above 40,000, up 560 points on the day, or about 1.4%. The S&P 500 up 88 points, or 1.6%, while the NASDAQ is going to close out the day higher by about 2.4%. And the Russell 2000, look at this, outperforming just barely by about 2.45% on the day.
Yeah, fascinating, right, to see that. In terms of, I'm going to go back to the big caps. I mentioned the S&P 500 up 6 days in a row. That's about a 6.5% gain along that. And then if I look at the S&P 500, Scarlett, you've got most names in the index, 414 to the upside. Tim had a really hard time finding decliners.
I know. I was thinking that too. Poor Tim. We'll give him a few more minutes to look for some decliners. But then that's really largely mimicked in the sector performances as well. 9 out of 11 sectors in the green, led by consumer discretionary. So those include your retailers, your home builders, as well as your car makers. Ulta Beauty leading the way there. Tech also gaining 2.5%. Materials, a surprise third place entrant there at 1.5% advance. And the laggards, REITs and utilities were little changed.
A lot of green there. All right, let's go to Walmart. Let's start with that name. Up about 6.5% in today's session. We know it was a top name in the S&P 500. The company raising its sales guidance for the full year. They talked about consumers buying necessities, seeking deals, even as they curtail spending elsewhere. But that upbeat outlook really gave investors some reasons to buy that one. Cisco up almost 7% here. Again, a top gainer in the main indices. That company rising the most in more than 4 years, at least on an intraday basis, the company gave a bullish revenue forecast for the current period, also announced plans to cut thousands of jobs as part of a strategy shift. We know that this has been going on. Scarlett mentioned Ulta Beauty up 11%. It is, or at least, it's the number one gainer, folks, in the S&P 500. Warren Buffett's Berkshire Hathaway disclosed that it took a new small stake in the cosmetics retailer. That was a 13F filing. Their shares shares. They bought more than 690,000, and that stake now may be worth about $251 million today. So a big one. I should mention Paramount too, also gaining, of course. The Seagram heir, Edgar Bronfman, saying to be preparing a bid for Paramount Global. I just wanted to throw that in, up about 7% today.
Yep. Invest in your face, guys. Invest in your face. Okay, Applied Materials coming out with the third quarter earnings. Net sales beating estimates, coming in $6.78 billion. You also had adjusted earnings topping estimates, coming in at $2.12 a share. Shocker. President and CEO Gary Dickerson saying the race for AI leadership is fueling demand for our unique and connected portfolio of products and services, positioning Applied to outperform over markets for the longer term, that AI play.
All right, shares of AMAT down by about 1.2%. In the meantime, I was able to find a few decliners out there. They were few and far between. Thank you to Carol Masser for quite a bit of help on these. Not every retailer higher today. Look at what happened at Dillard's, down 10.8%. Fell on Thursday, this after the department store company reported net sales for a second quarter that missed the average analyst estimates. Comp sales fell 5%. Consensus estimate was 2.9%. Men's accessories and shoes were the worst performing categories. Grab Holdings, the largest of Southeast Asia's ride-hailing and delivery firms, shares fell today by close to a little more than 7%. This after the company reported revenue for the second quarter that missed the average analyst estimate. And look at this one, Spire Global. It's not a company we talk about each and every day. We have had the CEO on our program. They're a space-based data analytics and space services firm. Shares tanked, falling more than 33%. This after the company notified the SEC that its 10Q for the quarter ended June 30th will be late. They're going to reschedule their second quarter results conference call and announce the timing once the filing date of its 10Q is confirmed. Investors responding accordingly.
All right, well, we had a pretty dramatic sell-off all across the bond curve, particularly in that front end, guys. The two-year yield moving the most since April 10th of 2024. Yields really popping higher and holding on to that gain all throughout the day, guys.
All right, guys, thinking about, we've always talked about getting together, doing a road trip or class trip together. So I have one for you.
We did?
We could do it between August 26th and September 2nd.
Who's driving?
If we go on New Jersey Transit, we could do
Transit?
I don't know about that.
We could do this ride, and, it's going to cost us nothing. So wouldn't that be a lot of fun?
What better way to thank the passengers of New Jersey Transit, at least according to Governor Phil Murphy, then offer free rides after the chaos of the summer? My question for you guys is, how does this help with sort of the crunch, the budget crunch?
It doesn't.
That the transit is facing as a result of, well, a lot of things that have happened for many years?
It's just like, look at something bright and shiny here. Free rides.
When nobody's going to be on transit because everybody squeezes in their last vacation days that weekend, right? Or around that time.
As a New Jersey resident, are you impressed by this? Are you disgusted by this?
Do you know what I think? My taxes are going to go up because that's one thing that happens a lot in New Jersey. I love you, Governor Murphy, but
this doesn't cut it, does it?
No. What do you guys got for us?
Well, there's a new study that's found that Americans appear to be pulling money out of their brokerage accounts to fund online sports betting. For every $1 spent on sports betting, which is legal across most U.S. states, net investments in stocks and other financial instruments dropped by just over $2. Again, an academic study, but Romain, do you think this is more correlation than causation?
Is this why we've been seeing the decline in volume in the equity markets? Let's face it. I mean, we always joke. Look, we have a lot of great people on Wall Street that we love, but we also know there are a lot of degenerate gamblers on Wall Street. So I think the Venn diagram between the type of people that would, take their money out of the stock market and go to the casino or vice versa, that's pretty strong.
Well, also, I feel like it's what they're measuring, right? Meme stocks, say, versus sports betting. But what about like zero-dated options? Like that, the retail share of that has been expanding, right? In the article they point out, it's over 18%. So is it really apples to apples in that sense?
What sport are they betting on, though?
Any sport, I think.
Anything.
You can bet on anything.
I don't know. Yeah, I think there's a
like
correlation.
I do wonder if we're going to start to see.
Whatever there's a line on.
I do wonder if we're going to start to see because gambling used to be something that was constrained to Las Vegas, constrained to only certain areas of the country, and now it is everywhere. It's on apps. It's so easy to do. I do wonder if we're going to start to see some sort of widespread pushback.
You could, but there's also the argument that people who are involved in gaming would make, which is it's not gambling, it's entertainment. People who are putting their money into sports betting don't necessarily expect to make money, but if they do, bonus. Otherwise, It kept them busy for a couple of hours.
You can lose a lot of money.
Yes, you can.
It's only gaming if you win, right?
There's a real reason why it's a business, right? That these companies are in business because the house wins. Like, it makes me.
There's also
nervous.
a reason they call it gaming and not gambling.
True.
The connotations are different.
Yeah, that's a good point.
No, the connotations are completely different.
It's the American Gaming Association, not the American Gambling Association.
But here's my point. It's your money. Can't you kind of do with it what you want? Is that bad to say? Like, if you want to bet on a meme stock or you want to bet on boxing, then like you can go ahead and do that?
Yeah, as long as you're not using meme stocks or sports betting to fund your retirement, sure.
I mean, but you could also do that too, and then that would just really suck for your retirement. But I'm just saying, it's not an apples to apples.
Sure you don't want to join me on New Jersey Transit?
We're really sure. Yeah, but thank you so much for offering.
You're very
Carol.
welcome.
We very much appreciate your generosity.
We can take it to Atlantic City.
Oh, yeah.
There you go.
That's a wrap. Our cross-platform coverage, guys. Alex is heading out. Romaine and Scarlett continuing on TV. Tim and I are going to continue here on Business Week on radio, but we will all see you same time, same place tomorrow. Well, not Tim. He's going to take the day off.
Again?
Yeah, I know. Tell me about it.
And we continue our coverage right here on Bloomberg Television. Stick with us. Marc Ganzi, the CEO over at DigitalBridge. He'll be joining us next. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. A really strong rally that we had here in U.S. equity markets here with an S&P 500 managing to close out the day higher by about 1.6%. Similar moves for all the other indices, with the Dow up almost more than 1% and the NASDAQ indices up more than 2% here on the day. You see the yield picture there, but I want to draw your attention to the two lines here on the screen. The VIX index at 15. That's actually lower than where we were right at the end of July before we started to see that volatility really start to explode. So we've done a complete round trip there. And you take a look at the XRT retail ETF here, having a phenomenal day, up 4% here. That's the strongest gain we've seen for that ETF going back to November of last year. And I think that might have to do with at least one big company.
Yeah, and that would be Walmart, right? It really tops the list of our big movers today. Walmart gaining 6.6%, closing at a record high here after a beat and raise quarter in which the CEO says we're not seeing any incremental fraying of our customers' financial health. So allaying some concerns about consumer spending here in the U.S. Meantime, AST Space Mobile gaining 51% on the day. The telecom company confirmed an early September window for the first ever, or its first ever, commercial satellite launch. And Sega Technologies down about 20%. It did plunge as much as 43%, so closing off of its lows. The drug maker said a study of its experimental therapy to treat Mpox failed to meet its goal. This, of course, comes the same week that the WHO, the World Health Organization, declared Mpox a global health emergency. But it really all comes back to the consumer. And our top story this hour is that it turns out the U.S. consumer is not in as dire straits as feared. You look no further than the bigger than expected gain in July retail sales this morning, along with Walmart's upgraded sales and earnings outlook. It goes to show the clear shift to value pricing, especially now that the job market is softening. But analysts say the key is for retailers to create reasons for people to spend intentionally, and that goes beyond low prices. It comes down to offering assortment, convenience, and differentiation. Later on this hour, we're going to talk about how restaurants achieve that kind of intentional spending with the CEO of Brinker International.
That's going to be a great conversation, and we're going to get to that in a second. But we want to focus a bit on tech and AI, because generative AI continues to drive that surge in spending for data centers. Companies investing tens of billions of dollars in the new tech, and our next guest, well, he's riding that wave. Marc Ganzi, he's the CEO of DigitalBridge. His firm invests in the infrastructure needed to power the AI revolution. And frankly, he's been an investor in the tech and telecom space now for a few decades. So no stranger to this, though the complexion, Marc, of what we're in now is definitely a little bit different. I am curious maybe if you can talk about some of the opportunities that exist in the data center space, because whenever we talk about the AI boom and the investment opportunities, so many people focus on the chips themselves and some of the hardware, if you will, but they kind of forget that big part of that infrastructure are the facilities that's going to hold all of this.
Yeah, thank you. Good afternoon, Romaine. Good to see you. You're absolutely correct. The chips are a big part of the driving CapEx, but remember, there's the picks and shovel part of the ecosystem. And that is really data center infrastructure, the fiber that connects it, the mobile towers that deliver it to your device, the small cells that sit on street corners in New York City, and the radio access network hubs where ultimately that mobile connectivity drives the cloud and drives all sorts of devices and connected devices. So it's a complex ecosystem, and our customers remain more CapEx than ever. And that's really the key headline today, is that we had a marketplace 10 years ago where we were building public clouds, spending $50 billion a year in CapEx. That has accelerated to over $200 billion per year by our hyperscale customers in the associated ecosystem. And we see CapEx remain accelerating to over $250 billion next year. So this AI train isn't slowing down. It's continuing to accelerate.
Yeah.
And we're sitting right in the vortex in it, not just in data centers, but all of the things we're doing at DigitalBridge today to ignite those systems and make it happen.
On that CapEx side, on the spending side, is there any concern here that some of the companies might be overspending, at least for public companies and what we've learned from their public disclosures here? There are a lot of investors that are looking at this spend rate and they're wondering when they're going to start to see the return on that spend. And I'm sure that has to be on your radar to some extent.
Oh, 100%. The health of our customers is critical. And look, we go back 11 years ago, 12 years ago, when we started building public cloud. And if you recall, it took 5 or 6 years to monetize public cloud. That started in 2011, 2012. And by 2017 and 18, we began to see material revenues coming from the hyperscalers. Today, cloud revenues are over $300 billion. But remember, that took 12 to 13 years to manifest itself. And I think the AI trade got a little ahead of itself, right? I think we could all agree on that. And our AI customers, which are those same hyperscale customers that built public cloud, are now building AI. And if we were playing a 9-inning baseball game, we're literally in the top of the 2nd inning. We have a couple of more years of hard work to do in terms of building the infrastructure. We're already beginning to see early returns on AI revenues from our hyperscale clients. We're tracking it very closely. As the largest private data center owner and operator in the world, we have a vested interest to see that those customers are healthy, and we think they are. But I think sometimes in the markets, as you know, the hype gets a little bit ahead of the reality. And the reality today is we're building those networks, we're building the associated data centers and the fiber connectivity, and it's a decade build. This isn't going to happen in 2 to 3 years, and the complexity is getting, to be more direct, it's getting more complicated to build data centers than ever. So this one's going to be a long, complicated build, but the monetization is coming.
The monetization is coming, and I guess I want to focus on the other part of your business, which is your fast-growing private equity business. Marc, your firm, I understand it, recently spun off the data centers to really focus on the PE business. So are you more a PE firm or a data center firm? Who do you consider your peers?
Well, you've caught it right. We were a REIT previously, and we made the transition to an alternative asset manager. And why did we do that? We did that because the amount of CapEx required to build these data centers is enormous. In our previous REIT structure 2 to 3 years ago, we couldn't deploy billions of dollars of capital. So we made the pivot to an alternative asset manager. And so today our peers are great companies like Blackstone and KKR and Brookfield, great competitors to have. And we're raising capital like they are, because ultimately to build AI, it's complicated, it's expensive, and the return, the payback to investors is a 5, 10, 15-year infrastructure return. It's not a quick quarter-to-quarter return.
So I guess one way to think about it is you're a financial services firm or a REIT, perhaps, that offers investors exposure to big tech. Is that right?
Yeah, we're an alternative asset manager. If you turn the clock back 4 years ago, we were at about 22 billion of AUM. Today, we're at about 84 billion of AUM. That's a 40% CAGR growth over the last 4 years. We're on a trajectory this year to deploy 30 billion of CapEx. So we'll push through over 100 billion of assets next year. And what we've told the street is that we'll double our AUM in the next 5 years. We feel really comfortable with that. And coming out of the last quarter where we raised over 16 billion of capital, we feel like we have obviously the infrastructure and the team to continue to put the right products in front of our LPs. We'll raise the capital, we'll deploy it. And then, of course, in due course, we're returning capital at the same time.
All right, we only have time for one more question, Marc, but I am curious if maybe if you can go a little bit more long term, particularly with the uses of AI. There's been a lot of talk about kind of the end uses, when we really start to see that materially filter its way through various industries and ultimately to the economy, basically that productivity boost that I think a lot of people have been looking for.
Well, look, it's again, I draw the analogy, Romain, back to public cloud because it's what we know. It's what we've spent the last 12 years doing. And we see how profound the public cloud is today and how it impacts our lives. And I think with generative AI, we get to go to the next level. And in terms of getting to that next level, you have to think in different dimensions. Obviously, the enterprise is the first place where we're going to impact the economy, where we're going to impact the workforce, and we're going to impact productivity and profitability. The second phase of that is machine-to-machine learning. And really, we really haven't seen the promise of IoT networks. We haven't seen the promise of autonomous driving vehicles, autonomous shipping, and other applications that can really change the productivity profile of America and the global economy. To me, that's actually more interesting. The B2B connections, the device-to-device connections and IoT networks are really going to bring productivity and profitability to levels we've never seen before. Yeah. But again, you have to have the infrastructure remain to make that happen, and we have to keep investing. We're long-term bullish on where this is going.
All right, Marc, really appreciate your joining us today. Marc Ganzi is CEO of DigitalBridge. And, we're talking about artificial intelligence and the data centers that go along with it. Of course, you then talk about the companies that are trying to really monetize off of it. Eric Schmidt, the ex-CEO and current executive chairman at Google, walked back some remarks in which he accused his former company of losing the AI race because of their remote work policy. He said Google decided that work-life balance and going home early and work from home was more important than winning.
Yeah, I think we all saw that comment and all kind of was like, okay, dude, seriously, step into the future with the rest of us. But it gets to the question, too, because I always thought Google always had more of a flexible work thing. I mean, even before the pandemic, right?
I don't know about that, but definitely during the pandemic and afterwards, they have 3 days work in the office, 2 days from home.
And just remember, because this is where I get to get on my high horse. Remember when everyone was working from home, everybody said these companies were going to circle the drain. Those companies posted more profits, more revenue growth when half their employees, but 90% of their employees were on their couch or at their kitchen table with a laptop. Why did they somehow think they would have done better if they had all been in the office?
Because in Silicon Valley, everything's a zero-sum game. And if Microsoft is winning with AI because of its partnership with OpenAI, then Google's not doing something else. So the Alphabet Workers Union, which represents about 1,000 workers, did push back. Yeah, I know. 1,000 out of 182,000 at the company. They pushed back and they sent out a tweet saying, flexible work arrangements don't slow us down. Understaffing, shifting priorities, constant layoffs, stagnant wages, and lack of follow-through from management on projects. These factors slow Google workers down every day.
Now that's a clapback.
That is, right? Oh, so there you go, Eric Schmidt. Take that. All right, coming up, we've got the top three where we focus in on the top three movers and shakers at the center of the day's biggest stories. This is Bloomberg.
Next week, Bloomberg is live at the Jackson Hole Economic Symposium, bringing you news and interviews with Fed leaders and other economic experts. Tune in for continuing coverage leading up to a special episode of Surveillance August 23rd at 9 a.m.
Time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Edgar Bronfman Jr., the heir to the Seagram fortune. Bloomberg has learned he is close to making an offer for Paramount Global, which would set off a potential bidding war for the film and TV studio.
Oh, gosh. I thought we were done with this whole Paramount Skydance saga. Well, good for him. Two things jumped out at me when you read this. First is, why couldn't I have been an heir to a multi-billion-dollar liquor fortune? Nevertheless, the other question, though, is, what's his plan for this, right? I mean, at least with Ellison, he did kind of articulate what he saw the future of these properties being. I don't know if I've heard that from Bronfman yet, and I know maybe he hasn't had time to do that, but it would be curious to see.
He's going to put together a package where the numbers will be super compelling, and then he can articulate his vision after that. Did you just roll your eyes? I think you did.
I did, a little bit inside. And if you didn't get that, I'll roll them harder next time. Let's move on to another person that I absolutely love, and that's Mark Zuckerberg, who apparently did something, I guess, sweet for his wife. Basically said he wants to bring back the Roman tradition of making statues of your wife. And, well, he made a statue of his wife. Take a look at this thing.
Oh, my gosh.
Okay, there you go. Without comment, that is his wife, Priscilla Chan, image of her, I should say, made out of silver and bronze. Now, I looked up the artist because I was curious about what this is about. He's world famous. He does these types of patinas on their thing, why she has that kind of green, teal skin, but I guess that'll even out over as it ages over the years here. This is just like in their backyard somewhere, apparently, though, which I think is even...
It's a 7-foot statue, which is massive.
How would you feel if your husband, you came home one day and in the backyard you saw a big statue of yourself there?
I don't know. know. I guess this is what billionaires do for fun.
Yeah, I guess you got to spend it on that.
You know.
That or a Stegosaurus.
Right. That costs $10 million. I don't know how much this one costs. Our third person.
But the Stegosaurus can't fit in your backyard.
No. Well, that one's going to a museum. He's donating that. Yeah, Ken Griffin. All right. Our third person is the incoming Starbucks CEO, Brian Nichols. His new $113 million pay package.
That's a lot of Stegosauruses.
I know. Makes him one of the highest paid CEOs in the U.S. But he gets a major perk. He can work remotely from Newport Beach, California, some 1,000 miles away from Starbucks headquarters in Seattle.
Does Eric Schmidt know about this? Well, first of all, kudos to him for negotiating that pay package. Also, we should point out a lot of that pay package is some of the compensation that he lost by leaving Chipotle. So they're just kind of making him whole for that. The remote work thing is a little curious to me.
Yeah.
I know CEOs travel a lot. They always say we don't really have a home or a desk or whatever because you're always traveling. But what's the message that sends to the
I know, to the rank and file who have to go in every day.
Yeah.
So one thing I learned from Beth Coet is that Chipotle allowed Nichols to move its headquarters from Denver to Newport Beach when he joined the company then. So it's really about what Brian Nichols can say and what companies will do.
Well, as you know, Scarlett, he is apparently the star CEO of the moment.
Yes.
So my guess is he can dictate whatever he wants.
He's calling the shots left,
and they're
right,
going to do it. And you know what? We'll change that. If for some reason he loses a lot of money for the company, but if he makes him a lot of money, all's good.
I'd rather be in Newport Beach than in, stormy and dreary Seattle.
Newport Beach is beautiful. When we come back, though, we're going to take a look at the Nixon shock that ended the gold standard and ushered in 50-plus years of fiat currencies. That conversation when we come back, as we take a look back on this day in history. This is The Close on Bloomberg. All right, time now for that walk down memory lane. On this day, August 15th, 1971, U.S. President Richard Nixon pitched to the nation a fire hose of economic policy changes designed to combat an economic winter that had seen inflation triple over 2 years, the unemployment rate spike above 6%, and a balance of payments surplus reverse to a soaring deficit. Facing intense voter pressure to avoid another recession, Nixon, at around 9 p.m. on a Sunday night, preempted the popular TV Western Bonanza to beam into American homes to say the time had come for a new economic policy that targets 3 areas: unemployment, inflation, and international speculation. It was a bombshell. Dubbed the Nixon shock, the president imposed a 90-day freeze on worker wages and consumer prices, the first time such drastic measures had ever been taken outside of wartime. He added a surcharge of 10% on foreign imports and, most importantly, suspended convertibility of the dollar into reserve assets. It was a breaking of a multi-decade gold standard that led to the irrelevancy and demise of the Bretton Woods system that had guided international finance since World War II. Put in its place was what would become more than a half century of globalization, flexible exchange rates, and open markets that shifted the U.S. and other major nations into interventionist directions. And while initially it was well received, the changes over time would have grave consequences, ultimately fostering a series of subsequent monetary and fiscal interventions that sparked double-digit unemployment, double-digit inflation, and double-digit interest rates. And the post-war economic growth rates from 1945 to 1971 on an adjusted basis, that would never be seen again. That contributed to the slow burn of economic angst we see today among Americans who increasingly feel they're getting an ever smaller piece of the pie. Now, to be fair, the gold standard and Bretton Woods was hopelessly outdated, a barbarous relic, as John Maynard Keynes once called it. But the gold standard and the Bretton Woods system were just that, standards and systems that provided the world economy with decades of stability. Stability that since the Nixon shock of 1971 has never been fully restored.
Yeah, getting rid of the gold standard allowed other things to come in, such as digital currencies like Bitcoin, for instance, in place of fiat currencies, as some believers would say. All right, let's move on to the real economy here, because shares of restaurant company Brinker International rallied the most in 3.5 months, rebounding from a 10% plunge that was triggered by its latest earnings results. Earlier this week, the owner of Chili's and Maggiano's Little Italy reported fourth quarter adjusted EPS that missed estimates. Kevin Hochman, CEO of Brinker International, joins us now. Kevin, when I look at the analyst reports that came out after earnings, they point out that you had one of your best quarters in recent memory with strong comp sales at Chili's, but the annual profit guidance seemed to be a little bit disappointing. Was this a case of investors punishing you for being too conservative in your outlook?
Well, that could be a part of it. You know, we had a breakout quarter. We were plus 15 at Chili's. That's 16 points better than the industry. That is a really amazing result, especially for a brand that's been around for 49 years. And we put some needed investments in as we had that influx of traffic coming in. A lot of them were new guests for the first time to Chili's, and we said, hey, let's make sure they have an amazing experience because we want them to come back. We don't just want them to come back or come to in Q4. So we put labor into the restaurants. We accelerated some of the deferred maintenance that we were planning on next year into this year that we had deferred during COVID. And we clearly missed the expectations of what investors, they were expecting to put all of that flow through, into profit. And then we set our guidance based on what we've seen in the macro, what we're hearing from other companies, right? And the reality is we haven't seen that yet. And so I think folks expected to see a higher guidance than we had put in there. And I think that's what happened with the stock. But I think as everybody started hearing about what had happened in the quarter and the great results, things sort of leveled out today.
You say we haven't seen that yet. I think about Walmart and in their earnings, how they point out that we're not seeing any incremental fraying of our customers' financial health. Can you say more about what you are seeing in your customers' health?
Yeah, so, we had July, when we said it on the earnings call, we were high single digits on sales, and we were positive in traffic. The industry was much worse than that. So we had another double-digit beat. And then early in August, we've seen similar results. In fact, we've seen a little bit of an acceleration, which we talked about on the call. So right now, we think we have superior value. We've done an amazing job in improving the experience. We have record guest scores. We've been at this for 2 years, making investments in labor and the facilities. We've cut over 22% of our menu to make things easier. So with more labor and an easier menu, your guest scores start going up pretty rapidly. And that's been a big part of our turnaround. It's why we've had such increases in our AUVs, and then obviously better four-wall economics means a much better stock price.
Have you found the need to do more promotional price promotions and other things like that?
Yeah, everybody's talking about how we jumped into these fast food wars, and the reality is we had been running this thing for almost 2 years now.
Okay.
We started advertising it about 18 months ago, and it was really working well. And then we saw in October, November, our social media experts are like, everybody's talking about fast food prices, and they're posting their receipts online, and oh my goodness, I paid $19 for this combo meal. And we said, wait a second, we've got almost half-pound burger, fries, unlimited chips and salsa, and a bottomless drink for $10.99. That's better than a lot of combo pricing, and certainly a much more abundant and better tasting meal. And we said, why don't we go ahead directly at fast food, talk about that pricing, and we did that in May, and that's when we saw an even more acceleration in business. So we've been beating the industry for 18 months, but it's really been double digits since May.
Is there, there's been a lot of talk, at least with regards to restaurant companies, the idea of just sort of finding a way to keep consumers happy, particularly consumers that are a little bit more value conscious. Longer term, though, is there a growth story here? What are you doing to grow this business beyond whatever economic conditions we're in right
absolutely. Now? So I call this, what we do is we're working on the fundamentals of casual dining, and those have not changed. So differentiated brand, craveable items that people think of when they think about going out for food, right? Yeah. And then you got to deliver great service, and you got to do it in a friendly, clean atmosphere. And a lot of people say, isn't that a little bit of motherhood and apple pie? It is. That's why people do casual dining. But the reality is very few actually deliver that, right? Yeah. We know there's a couple of guys out there that perennially deliver that, and you know what? They've had, growth in their business, expand their margins. That's what we want. That's what we've been doing the last 2 years. We have record guest scores now. We've had record growth. We haven't had this much growth in the last 2 years, in 20 years at Brinker. And we've had dramatic improvements in restaurant operating margin and our EBITDA. We had a record EPS this quarter, or this year.
Are you opening more stores?
We are. We open about 10 to 15 a year. I will tell you, we're mostly focused our capital on paying down our debt and improving the facilities of our existing stores. So we do have a little bit of growth there, but it's not going to be our story right now.
You said you hired more, you're improving your facilities, you're reinvesting in the business. I'm curious about how you manage your inventory better, because as any retailer knows, if you're beholden to these cyclical headwinds, then you've got to really deliver and perfect on your execution. So how do you do that at restaurants? At a retailer, you might not order as much merchandise so that you don't have to mark down things, but what do you do as a restaurateur?
So we've done that masterfully in the last couple of years. So we've reduced over 22% of our menu. So that means a lot of pantry SKUs or ingredient SKUs that we just stop ordering. We've also consolidated a lot of the prep SKUs, and we've gotten rid of prep steps. All that means is you're putting more volume into less SKUs, and when you do that, you get more turn. So that is probably one of the single biggest things that we've done in our business is the simplification We're getting it from the restaurant managers. We're putting it in place, and they feel more engaged because it's easier to run a Chili's right now. So we've done a masterful job with the menu. Because usually when you cut SKUs like that, you lose sales, but we've had record growth.
And you're doing this across the other restaurants as well?
Well, Maggiano's is our other concept, and we're just getting started on that turnaround. So we're really going through the same process of using the managers, tell us your ideas, and then let's accelerate the business with innovation and demand creation.
Yeah, it certainly keeps them invested as well.
Oh, my goodness. The turnover's never been better right now with our managers.
All right, Kevin Hochman, CEO of Brinker International, thank you so much for joining us.
Thanks for having us on.
I love the ticker, EAT, E-A-T.
It
makes it easy.
Any better than that,
right?
Yeah.
It really makes you hungry. So.
It does. This is a great story. We've been talking a lot about today, Scarlett, about consumer prices, obviously because of the retail sales numbers, but specifically when it comes to food, right? And some of the trade downs or trade offs that some consumers are having to make. I wonder if when we're going to start to see a little bit more of this show up on the campaign trail. Yesterday, we heard from the Harris campaign talking about them potentially going after price gouging. I'm using her words, not ours, in the grocery space. We're awaiting a press conference now by former President Donald Trump at his country club in Bedminster, New Jersey. And I was just looking at the shot going into it here. He's got a lot of food laid out on the table here, so we don't know exactly what he's going to talk about.
There he is.
You see the former president walking out there right now. You see in the background there, he's laid out a lot of food items here. We don't know exactly what he's going to talk about, but we do know that his campaign did say that we hear something about his economic policies. Let's listen in right now. Former President Trump in Bedminster, New Jersey.
The weather, it's very nice place, nice location. And I do thank you for being here. And we don't have very much heat, so I'd say it's perfect weather for this. The rain is not imminent based on the fact that there are no clouds. So it's really nice. It's really nice. And let's go over some big facts and some very substantial truths about where we stand as a country, because we're a failing nation because of the way it's been run for the last 3.5 years. We're a failing nation. People are coming into our country by the millions and millions and millions. We have no idea who they are or where they come from. But we're also a failing economy. Kamala Harris is a radical California liberal who broke the economy, broke the border, and broke the world, frankly. Very destructive to the entire world, because as we go, oftentimes the world goes. She destroys everything she touches, and if she wins, your finances and your country will never recover. You're never going to recover. A radical left person wants to put price controls all over the place, which will end up driving up your prices, not down your prices. Harris has just declared that tackling inflation will be a day one priority for her. It's going to be day one. But day one, really, for Kamala was 3.5 years ago. Where has she been? And why hasn't she done it? Why hasn't she done it? I hear her complaining all the time. She was the border czar, but she didn't do anything. It's the worst border czar in history. There's never been a border czar so bad. She's been unbelievable in terms of her badness to some of our allies, some of our great allies. You know who I'm talking about. Here is the record of economic calamity that Kamala is desperate for voters to ignore. She cast the tie-breaking votes that caused record inflation. She cast the votes. She's trying to blame Biden, as you know. So it was Biden, but I'm going to do a better job. But it was her. And if she wants to do a better job, she's still got 5 months left, right? But she can't do a better job because she doesn't know how to. And she's of a place in life where she wouldn't know what a better job is. Going to destroy our country. And as a result of Kamala's inflation price hikes, they've cost a typical household a total of $28,000. These are numbers coming from government. They're not coming from me. $28,000 she's cost a typical household. Kamala's inflation nightmare continues to cost the average American family $1,100 every single month. $1,100. Again, government numbers. You're paying $148 more a month on food. That's every month. Average family because Kamala.
And we're listening right now to former
her
President Donald Trump, of course, the Republican nominee for the current presidential election cycle, talking about economic policy, starting off this press conference with some criticisms here of the Biden-Harris administration and their shepherding of the economy, Scarlett. And he hasn't quite gotten to his own policies there yet, but you can see behind him he did have kind of an array of food items here. There's been a lot of discussion about what people are paying at the grocery store, some of the stresses that consumers are seeing. And of course, I think a lot of voters want to know how each one of these candidates would sort of address these issues should they be elected in November. Absolutely.
So let's bring in Bloomberg's Joe Mathieu, who is in Washington. And Joe, we know that President Trump or former President Trump is going to get to the point of prices, but he did mention and trying to attach Kamala Harris to inflation, saying it was Kamala's inflation price hikes that is really causing Americans to feel the pain of this current economy. What do we know in terms of what the Harris campaign has put out or has hinted at in terms of prices?
Very little, to be honest with you. So far, and certainly after what we saw today as Kamala Harris spent time on stage with Joe Biden for the first time since he dropped out of the race, it was very much the Biden-Harris agenda. But when she speaks tomorrow, and it's not a coincidence that he shows up there with all the groceries, she's going to be talking about food prices in part tomorrow and pitching an idea to have a federal ban on price gouging in food. Namely, and that's something we're going to hear about from her in the next 24 hours or so. That might be a little bit of a different wrinkle, but largely the same exercise as they try to take credit for lowering prices to the extent that they have. But it reminds me of 1992, George H.W. Bush. He was put on the spot to ask what a gallon of milk cost. I see 3 gallons out there with Donald Trump, and I do wonder if any of the candidates can answer that question.
Yeah, it's a nice lineup. He's got some Folgers, honey bunches of oats, Jimmy Dean sausage. I mean, all of the fan favorites out there, Joe. And anyone who actually does go to the grocery store, you know, salt of the earth people like you and me, we know that these items are costing more than what they were a few years ago. I mean, that's just a fact, right? I guess the question 100%. Really is where does that blame lie? And I know it's this is what candidates do. They're always going to blame their opponent for these problems here. Do you think that's going to be an effective message for voters?
Where does the blame lie is a great question. Is this, the remnants of COVID, or was it because of overspending by Joe Biden at that same time when he took office? I'm not sure voters are going to be able to answer that question based on what they hear from both campaigns. But the Harris campaign, Romaine, is hoping that it won't matter, that data like we've been seeing in the last couple of weeks will continue straight into November, where we are down getting to the point of 2%. The Fed is cutting rates, and the job market hasn't suffered damage enough where people are starting to notice. That actually might be stars aligning for Kamala Harris, and the stakes are awfully high when you look at it that way.
Absolutely. I'm curious. We know that President Trump is going to be talking about his economic policy. What has he laid out so far in terms of what he plans to do in a second administration that he didn't do in the first?
Well, when it comes to the economy, and, look, we had a stemwinder yesterday. He spoke for some time about a lot of different issues, from the border to different attack lines against Kamala Harris. He did isolate a couple of ideas, as we've heard, beginning with drill, baby, drill. He talked about, lowering red tape, lowering regulations, of course. And it's difficult to put this together with tariffs. And the idea, because he talked again about that 20% across the board tariff, and the idea of making permanent the Trump era tax cuts, how that is not inflationary when you put all this together, is an answer or a question he has yet to answer. That's going to be the test for the Trump campaign, about how you can do all of that at once without paying for it.
You can catch Joe Mathieu alongside Kaylee Lines at the top of the hour. Balance of power here. We should point out that the president's press conference is still continuing. You can type live go onto your Bloomberg terminal to continue to hear that conference. And of course, Joe and Kaylee at the top of the hour will have a full wrap up and breakdown of everything that just transpired there. We do want to go back here to the markets and focus a little bit on municipalities. It is our Muni moment. And we're going to talk a little bit here about mass transit, because every major city with mass transportation has its low points, but the transit system in Boston is on an unprecedented struggle bus of its own. The Massachusetts Bay Transportation Authority has been scrambling to address lower ridership, service disruptions, aging infrastructure, and a funding crisis. It's the focus of our Muni moment today, and joining us to talk about it is City Councilor of Boston's District 2, Ed Flynn. All right, Ed, sitting here in New York, I am not one to throw stones. I mean, we have our own issues when it comes to mass transit here. But talk about what's unique to the issues facing Boston's public transit system.
We've had a difficult period of time with our MBTA system, especially during the winter time. The system doesn't work effectively. Most of our workforce lives outside of Boston, throughout greater Boston. They rely on public transportation to come into the city, into the downtown area through the MBTA system, especially during the winter time. It's extremely challenging. And that's one of the reasons companies are really not fully remote, is because of our struggling transportation system here in Boston and Massachusetts as well.
What's the solution, Ed? I mean, other than just more money, is there a better way to go about this?
We have very old infrastructure, and a lot of our trains operate outside, not in the tunnel, but outside, and are impacted by the elements, by snow, by rain. I almost thought that during the pandemic, we had an opportunity to completely shut down the MBTA system and dramatically improve it. Certainly that's not possible now, but that type of drastic situation, in my opinion, is needed, where we have to almost shut down a major portion of the MBTA and make significant changes, knowing that it will impact workers trying to get into the city and cause economic challenges as well.
Yeah, and this is something that I think every transit system in the U.S. and around the world has to face, how to figure out the maintenance and the upgrade of their system. Is there anything longer term, like a congestion pricing plan, even being discussed? I know that New York had planned to do something like that before the governor of New York put it on indefinite pause, but I'm curious whether that's been brought up at all?
Yes, it has. There is active discussion on the city council about establishing that. I came out against that. However, I don't feel at this time, during these economic challenges in Boston, that congestion pricing would work. It would have a devastating impact on our business community and our low-wage workers as well that come into Boston to work, especially through the MBTA system, or driving into downtown Boston because of the challenges we have. But I do think it would negatively impact Boston's economy and especially our low-wage workers. I'm against it, but there is active consideration for that proposal.
Okay, yeah, I mean, multitude of voices, I would expect that would come up. Speaking of a multitude of voices, just recently, Boston has gained a seat on the 9-member MBTA Board of Directors. What will be the message from the Boston representative to that council, to that Board of Directors?
Boston, in the city itself, relies heavily on the bus transportation as well. Buses can get from neighborhoods into the downtown area, but we also have to ensure that our riders have safe rides on the buses and in the trains. But we have to do more work on ADA, American Disability Act compliance, to ensure that persons with disabilities have equal and fair access as well. I think that's an important consideration for Boston during this period of time.
All right, Ed, going to have to leave it there. Appreciate you taking time for us to talk about a really important issue, not just for the residents of Boston, but I think any major city dealing with public transit issues. Ed Flynn of the Boston City Council. And we always talk about Boston obviously being kind of the cradle of so much of our democracy. But fun fact, Scarlett, I did not know it was actually the birthplace of public transit here in the U.S.
Oh, I had no idea.
Yeah, the very first subway tunnel ever built is and still in operation, actually, in Boston.
Well, there you go.
Yeah. All right. Well, still ahead, we're going to set you up for some of the potential market-moving events over the next 24 hours. That conversation when we come back. This is The Close on Bloomberg. All right, it's been a busy day on Wall Street. We're going to set you up for some of the potential market-moving events over the next 24 hours, and we go across the pond, Scarlett, to the United Kingdom.
Yeah, and the United Kingdom, whose economy is doing better than had been anticipated, retail sales are expected to rebound from negative prints in June. So we'll wait to see how that shakes out.
All right, maybe that's the Aviel Brown effect. Meanwhile, back here in the U.S., we're going to get some housing data here. Housing starts, Scarlett, 8:30 a.m. tomorrow.
And you wonder if the recent drop in yields is going to make any difference. I don't think that translates into housing starts, but we did see it certainly move the mortgage refinancing number.
Yeah, obviously starts is on a much longer trajectory, so these people have to kind of plan for, what's going to happen 10 years from now rather than just a year from now. But it does kind of still reflect kind of builder sentiment and things like that, and how much confidence they really have in long-term trends. I'm always curious about those numbers too, because I want to see where geographically where the trends are going, where are people moving, where's the puck going, to use a hockey analogy.
Yeah, go to where the puck is going. Yep.
All right, we're also going to get a read on consumer sentiment tomorrow morning as well.
Yeah, this will be really interesting because not only do you have confidence, and so much of that is tied to politics. We were just seeing former President Trump speak earlier. I wonder how that's going to trickle into the sentiment index, but also what consumers say about their inflation expectations for the 1 year period, for the 5 to 10 year period. Right now, the consensus estimate is for both of those numbers to be below 3%.
Yeah, and it gets to the point, too, when we talk about sentiment and the disparity that you see between sentiment sometimes and the data, how much of that could become a big-time election issue, meaning how people feel about the economy is kind of a priority over the actual data. Yeah, absolutely. And I know you asked for it, Scarlett, so you get it. Austin Goolsbee going to speak again tomorrow.
He's spoken a lot recently.
He has been very chatty as of late here. I guess this is the prelude to Jackson Hole, the prelude to the September Fed meeting. And we are a prelude to Balance of Power. It's coming up next, right here on Bloomberg.